Hey everyone, welcome to another video by Optionables. My name is Saket and in this video we'll be discussing a budget strategy. So today is a special video which we'll be putting out ahead of the budget because tomorrow we'll be going live on YouTube and we'll also be trading live for the budget. So before I actually go live, I'll also be sharing which strategy we'll be using on the budget day, and I will also show you how to automate this strategy absolutely for free using Target. So generally, ahead of the budget, the market is expected to be very volatile. So that's the reason even the option premiums will be very high. If you actually look at the short straddle premium right now, it is trading around 950 points. But whenever you look at short straddle premium on a Tuesday end, it will generally be somewhere around 450 to 500 points. That means we are getting double the premium because of budget. Since the market is expected to be very volatile, the premiums options will be pricing in also will be very high. But once the budget is over, the option premiums will start to crash because of the dip in IV. So the IV will generally tend to be very high when there is a lot of uncertainty, and when we go to a budget, we don't know what is the outcome. So budget can be good, budget can be bad, and since we don't know the outcome, there is a lot of uncertainty around. And because of this uncertainty, the premiums will also be very high. But once the budget is over, the event is now certain. You already know what is in the budget and it has already come out. Hence, the things are more certain, and that's the reason the volatility will end up crashing. In this strategy, what I will be discussing, we'll try to use this high volatility and short options so that once the budget is over, the option premiums will usually end up crashing. I'll be discussing the whole strategy, the logic, and how to automate this whole thing for free in the screen recording, which will be moving on now. So meanwhile, if you have liked this video, do not forget to hit the like button, share this video and subscribe to Optionables. And also, most importantly, don't forget to join us live on YouTube tomorrow starting from 9:30. Hi everyone, welcome to the video. In this video, we'll be discussing about the budget strategy for 2023. So I'll be telling in detail what exactly we are going to use tomorrow, and I'm going to show how you can automate it completely, and also will be going live tomorrow from 9:30. One important thing is, after we discuss the strategy, I'll be showing the back-tested report of these strategies from 2017. But what you have to note is, just because this has worked in the past, there is no guarantee this strategy is going to give you profit even this budget. This strategy might end up giving you profit or might end up giving you loss. But whenever we are trying to build a system or whenever we are trying to build a strategy, we are going to approach it more in a systematic way. So on a budget day, we can divide market into two phases. So this would be phase 1 and this would be phase 2. So phase 1 is generally from 9:15 to 12 o'clock. So this is the phase when the budget speech will actually happen, and this is the time also when the IV or the implied volatility of the option will be very high. So usually while budget speech is happening, you see that the option premiums will be extremely high. So this is the phase where we have to use to short options. So generally, as I told you, right now, ATM straddle premium is pricing in somewhere close to around 950 rupees. And this is very high, almost double of what you find usually, right? So we can make very good use of this high premium in the morning phase when the implied volatility is very high, right? So post 12 p.m. comes the second phase where the IV starts to drop. So from 12 p.m. to 3:30 p.m., what exactly happens is our finance minister will be done with the budget speech. Now things will start to get more certain. What do I mean by things will start to get more certain? Because in budget, there is always a lot of uncertainty. There might be a new policy which is going to be very beneficial, or there might also be a policy which might not be so beneficial, right? Because of all these uncertainties, we are going to see a higher premium. But once everything is over, the premium is going to crash because of both reduction in the volatility or reduction in implied volatility and also theta. So this short straddle, which has a premium of 950 rupees in the morning, we might end up seeing the short straddle premium trade around 400 to 450 by end of the day. So this is just my estimate based on the previous budget trade days. We might see as much as 50% drop in the at the money straddle premiums as we move towards 330. So once we are clear about this, now what we will end up doing is see what strategy we can end up creating. So the strategy, whatever I'm going to suggest now, is going to be very simple to execute. So now what will happen as the budget speech begins, right? So the market is going to be very volatile. So the market will end up moving higher, then it will end up going down, and then it might move in all sorts of pattern during the budget speech. From 9:15 all the way up till 11:30, 12 o'clock, it might move in all patterns possible. So that's the reason what we want to do is try to make use of both highs and lows of the market. So that's the reason we will end up creating short straddles at different time periods. So for every 30-minute interval, we will end up creating short straddle. So starting from 9:30, we'll create one short straddle. Then 10 a.m. we'll create another short straddle. Then 10:30 we'll create another short straddle, and finally at 12 o'clock one more short straddle. So totally we will end up creating almost close to around 6 short straddles at different point in time. Why exactly are we doing this? The reason is simple. We want to make sure that we have a short straddle created at all the highs and lows of the day. So it can be here, it can be here, it can be here, just so that one of the short straddles can end up giving us very nice DK or a lot of profit. So this is the only idea, and we will end up creating Bank Nifty ATM short straddle at 9:30, 10, 10:30, 11, 11:30 and 12. I already explained about the first phase of the market and second phase of the market during the budget day. And here we will end up creating short straddle when the premium is high, when the IV is high, so that we can make the most of it when the IV ends up crashing. So while the IV is crashing, also you can end up creating the short straddle, but I would prefer creating or making use of the opportunity when the volatility is high and also premiums are high. So once we have done that, then it is fairly simple. So I'm going to quickly explain the strategy logic in a very simple way, and I'm also going to show you the backtested result. At 9:30, we'll create our first short straddle. Assuming that we are going to get a short straddle premium totally at 1000, that is call option trading at 500 rupees and put option trading at 500 rupees. So this is our CE leg and this is our PE leg. So what we are going to do now is very simply place a 50% stop loss on both the legs. So the stop loss is going to be 50%. The stop loss for put leg is also going to be 50%, which means 500 plus 50%. So how much is 500 plus 50%? It is nothing but 750. So our stop loss is going to be at 750. So I am shorting a CE at 500 rupees. I am shorting a PE at 500 rupees, and I am going to keep a stop loss at 750. So this is a very simple trade which we are going to take. Simply end up creating a short straddle at 9:30, see what are the premiums and calculate 50% of that and place a stop loss. So why exactly are we taking only 50%? The answer is very simple. In case if the market ends up consolidating in a broad range, then our stop loss is not going to hit. But in case if the market ends up trending, our stop loss will hit just in time so that we can capture the move. So if we keep the stop loss too narrow, like say 10% or 20%, generally during the first hour of volatility itself, our stop loss might end up getting hit. We have kept the stop loss wide enough to make sure that it doesn't actually get hit while the market is moving up and down, and also we have kept it closer enough to make sure that we can also capture the trending move. So once one stop loss gets triggered, let's say the market shoots up post budget and the 750 rupees call leg stop loss is hit. So once that is done, we are simply going to move the other leg stop loss back to cost. So that is, we have entered at 500, placed the stop loss at 750, and we are just going to put the stop loss back to cost at 500. So this is nothing but move to cost. So I'll try to explain the strategy in simple terms. At 9:30 a.m., end up creating a bank nifty short straddle by shorting a call leg and by shorting a put leg. Once you have done that, just place a 50% higher stop loss. So if you have got a leg at 500, you're going to keep a stop loss at 750. If you have got it at 400, you're going to place a stop loss at 600. So on. Just calculate the average price plus 50% and end up creating a or placing a stop loss. Now, assuming that either your call or put leg side hits the stop loss, so the market goes up and your call leg hits the stop loss, simply move your stop loss of your put leg back to your put average price or back to cost. So similarly, let's say the market falls down and your put leg stop loss gets triggered, then simply move your call leg stop loss back to cost. So this is all you have to do. This is a very simple strategy to execute, and now I'm going to show you the result. So this is the same strategy what you are going to follow at 10 o'clock, 10:30, 11 o'clock, 11:30 and 12 o'clock. So totally we will be having 6 different entries starting from 9:30 to 12 o'clock. We will be keeping the same stop loss and also will be using the same logic of move stop loss to cost for all the 6 entries. So now I am going to show you the back tested results of the same. So here you can see that I have opened multiple Stockmock tabs where I have back tested from 9:30 all the way up till 2:30. So that's the reason I will be able to explain why exactly it is better to end up creating strategies during the first phase of the market compared to the second phase of the market on the budget day. One more thing is that I'll be attaching a Stockmock link in the description. So using this link, you will be getting 40 paid credits. And also, if you don't know, you can end up testing on the budget day unlimited number of strategies on Stockmock. So it is completely free to test all the strategies for budget day or RBI policy day on Stockmock, right? So now we will go and look at the individual statistics of the strategy. So you can see that out of the previous 7 budgets, right? If you had used this strategy entering at 9:30, so you can see the entry time is 9:30. So 71% of the times, or 5 out of 7 budgets, you have made a profit, and 2 budgets you have made a loss. Here expectancy is 1.25, and trust me, this is a really good expectancy to have. Anything over 0.8 or 0.9 is really good to have. So here the expectancy is 1.25. So similarly, we will come at 10 o'clock. So when you come at 10 o'clock and when you look at the statistics of 10 o'clock, you can see all 7 out of 7 days you have made profit by executing this at 10 o'clock. So there is no day when you have made a loss, and that's the reason you see here the return to max drawdown is infinity, even the expectancy is infinity. And since we have finished seeing at 10 o'clock, now we are going to go to 10:30. 10:30, again you can see there has not been a single day where you have gone to a loss. So executing this on a budget day specifically, there is not a single time when you have actually gone to a loss. All 7 out of 7 days you have actually made profit. So now from 10:30 we are going to look at 11 o'clock. So 11 o'clock you can see there is only one day you have made a loss, and remaining 6 budget days this strategy has given you profit, and the expectancy here is 0.86. As I told you, anything over 0.8 is really good, and if it crosses 1 or 1.2, that is excellent, right? So now 11 is over, so we'll move on. So again, when we actually take a look at 11:30, you can see that 7 out of 7 days, this strategy has given us a profit. Again, very simple. You are going to create an ATM short straddle, keep a 50% stop loss, and move stop loss to cost in case if one leg hits the stop loss, right? So 7 out of 7 days, it has given you a profit, and that's the reason expectancy is infinity, even return to max drawdown is infinity. So now we are going to look at 12 o'clock, right? So again at 12 o'clock, you can see totally 5 out of 7 times you have made profit, and your expectancy is 1.48. So even this is pretty good because it is above 0.8. So now the thing is, we will start looking at the overall profit. So you can see by executing this in the morning, you have overall profit of 17,000. So when you execute this at 9:30, overall you have made a profit of 17,000. So when you execute this at 10 o'clock, you have made an overall profit of around 20,000. Similarly, at 10:30, you have made 22,000. Similarly, at 11 o'clock, you have made 17,000. At 11:30, you have made 33,000. And at 12 o'clock, you have again made 15,000. That means you are actually down. You have just made 15,000 rupees. So now going from 12:30, we are done with the phase 1. Now we are moving towards the phase 2, right? So where budget speech would be most likely done, and we'll be moving to the second phase where the premiums will start to dip. So we'll look at 12:30. So when you look at 12:30, again 12:30 you can see the profits have dipped. So previously at 9:30 you started with 19,000, all the way went up to 33,000, and at 12 o'clock you were back to 15,000, and now you have further dipped to 12,000. So the expectancy is 1.65, which is really good, but you have further dipped to 12,000. So now we'll go to 1 o'clock. So when you look at 1 o'clock, you can see the overall profit is just 200 rupees. That means you have not made any profit by executing this at 1 o'clock. When we come to 1:30, you can see again the overall profit has dipped to 2,000 rupees and your expectancy is 0.5. Now let's look at 2 o'clock. Even here you can see overall profit is 4,000. So you can quite clearly see why there is a big difference in phase 1 and phase 2. In phase 1, all the execution time came with a minimum profit of 15,000 and a maximum profit of almost up to 33,000 overall profit. But in phase 2, where we are looking after 12 o'clock, you see the profit is relatively very low. Why exactly this is the case? The answer is the premiums would have already started dipping and the markets will be average overall profit post 12 o'clock itself is somewhere around 4,000 to 5,000. But before 12 o'clock, the average profit would be somewhere around 20 to 23,000. Right. So, and finally, when we take a look at 2:30, again, you can see overall profit is just 1,000 rupees. So that means it is okay not to execute these strategies post 12 o'clock because the risk to reward is not in your favor. Previously, based on the previous data, you see that if you end up executing any strategy before 12 o'clock, there are higher chances that you will end up making a profit, especially during the period from 10:30 till 11:30. If you actually end up executing a strategy, most likely you will end up making a very good profit. So this is the reason why exactly we are only going to execute our strategy in the first phase, that is from 9:30 to 12 o'clock. And now I'm also going to show how you can automate the entire execution using target. Be volatile, so the premiums in the market wouldn't be enough to compensate the volatility, and that's the reason you can see as we move from 12:30, 1 o'clock, 1:30, 2 o'clock, the overall profit is actually dipping. It is hardly around 2,000 rupees, 3,000 rupees. Target is again a free to use platform where you can end up registering. So this is a platform by Optionables. So once you register, you can simply log into your account. So right now we have tied up with Firstock. So you can log into your Firstock account. So once you enter, this would be your home screen. Here, very simply, you can end up creating a new strategy. So I'll name it 9:30 Bank Nifty Short Straddle. I'm going to sell 25 lots, and at the call leg, I'm going to select put leg, again 25 lots. At the put leg, very simply keep a 50% stop loss and select move stop loss to cost. So the entry time would be 9:30. The exit time would be 3:23. So I'm going to save this. So here you can see I have created 9:30 Bank Nifty short straddle. Likewise, I'm going to create all 6 strategies and save it. So as you can see here, we have created 6 strategies starting from 9:30 all the way up till 12 o'clock. So with Target, you can simply end up creating as much as 15 strategies and just with one click. So tomorrow morning, all I have to do is come and click on run, and this entire strategy is going to get automated absolutely for free. So you can just come, click on run, and just close the window and go. So moving stop loss to cost, or placing the stop loss, or placing the orders, the complete execution from end to end will be taken care by Target. So tomorrow we'll be going live from 9:30, and I'll see you on YouTube tomorrow. So this is the strategy what exactly we'll be using, and I hope you have liked this particular video. I have discussed the logic why exactly we are entering from 9:30 to 12 o'clock, what is the reason behind it. So if you have liked it, do not forget to hit the like button, share this video, and also subscribe to Optionables. Thank you so much for joining.